Hello and good afternoon, good morning everybody. My name is Matthew Watkins. I work as a manager in WBCST's Redefining Value team. It's very much a pleasure to welcome you to our webinar today on assessing and managing integrated performance. We're very lucky to be joined by four fantastic speakers today. So we have Mario Abella, Director from Redefining Value from WBCST. We have Peter Spence, who is the Associate Director for Research and Development at AICPA CIMA. We have Stefano Zambon, Professor of Business Economics at the University Ferrara and a member of the World Intellectual Capital Initiative. And we also have Karen Sanning, who is a Policy Officer at DG Environment at the European Commission. So I'm just going to whiz through a few housekeeping points before we hand over to Mario and the rest of the speakers to go through the content. In terms of the agenda for today, Mario will be providing context and overview to the work, and we'll be handing over to Peter to take us through enterprise performance management. So this is around decision-making within businesses. Stefano is going to be telling us about intangibles and reporting. And by intangibles, what we're really talking about here is the hidden value of people and ideas that doesn't necessarily find its way into business balance sheets and financial statements. We're then going to be handing over to Karen to give us a European policy perspective on business value creation. Following this, we'll jump into a panel discussion with some audience Q&A before going into wrap up. And just on this one point, we will have the chat function available. So there should be a chat icon on your Zoom window. If you would like to give any questions for any of the speakers when we come to the panel, then please don't hesitate to put these into the chat function, and we'll get around to them when we get to the end of the presentation. Just a quick point on WBCST. Probably most of you on the line know that WBCST is an organization of 200 global companies striving to achieve the vision of 9 billion people living well and within the planetary boundaries by 2050. The makeup of the WBCST membership is quite diverse. These 200 different companies, all of which are really significant businesses, working with WBCST the opportunity to provide real impact at really significant scales. Just a quick word to say that we do have 6 programs. The program that we're going to be focusing on today, however, is our Redefining Value program, of which the top line is really around aligning the financial system and non-financial system to really create and reinforce incentives for businesses to be more sustainable. This is one of a series of virtual events that we're holding on Mondays and Wednesdays, and you can find the full list of upcoming events at the link on your screen. Just a quick piece of housekeeping is to note that the meeting is being recorded. All participants are muted, but as we were saying, please do get in touch with us on the chat function if you'd like to submit any questions for our panel at the end of the session. And one last point, this is a pre-competitive space, so please do be mindful of any discussions, avoiding areas including pricing costs, bid strategies, future capacity and additions or reductions, customers or output discussions. So before I hand over to Mario, I just have 2 questions that I would like to ask you by using the polling function. So the first is just for our internal use at WBCST. We are very interested to hear how you heard about the event. So it would be fantastically useful for us if you could just take a few seconds just by filling in this poll and telling us how you heard about the event. Okay, thank you very much for filling this in. This is extremely useful for our events team. Okay, and I did just want to ask one more question, which will lead into some of the discussion that Mario is leading. So this question is, what is the most common understanding of performance management in your organization? We have a couple of different multiple choice questions here. Is this around employee performance, overall financial performance? Is it about business units or geographic performance? Or is it broader strategic concepts covering both financial and non-financial data? So I'll just give a couple of seconds for people to fill this in. And then I'm going to be handing over to Mario to tell you a little bit about Mario's perspective on integrated performance management and to go through the background and context of some of the work that we're going to be talking about today. So Mario, I'm sharing the results of the poll now. So you can see that we have a lot of people saying employee performance, and also a lot of people talking about a broader, more strategic concept in terms of performance management. So thanks everybody for filling that in, and I hand over to Mario.
Thanks, Matt. So, hello everyone, my name is Mario Abella, Director here in the Redefining Value team at the WBCSD. Welcome to this webinar today where we're showcasing our integrated performance management project or assessing and managing performance. One of the most difficult projects that we've undertaken at the WBCSD, and as we work through the various presentations, you'll come to see why this is a very important topic, but also a topic that goes to the very heart of business. So next slide, please. PwC does a survey of global CEOs, and they compared results from 2009 and then 2019. If I just quickly take you through the chart, the top line shows what areas CEOs believe are really important to driving value in their business. Unsurprisingly, there are areas such as brand, reputation, employees, customers, but then when the CEOs were asked about whether or not they were provided with adequate information about each of those topics, you'll see that the results are fairly poor. So there's this enormous gap where, you know, managers are recognizing that there are some really important dimensions to value creation, and yet we're unable to provide sufficient data within the business to inform CEOs. So that's one of the key takeaways here in terms of really noting that this situation hasn't changed since 2009. So you'll see that the grey line and the yellow lines on this chart are not radically different, which shows that over a decade, not much has changed, and we still have this information deficit on things that we know that matter. On to the next slide, please. And we know for a lot of companies, the nature of value in their business is changing quite profoundly. So in terms of, if we look at these two stacked bar charts here, you'll notice a small percentage of value is captured in the financial statements. There's still a large amount of value that's not captured at all. And Stefano is going to speak about this in his presentation. This large kind of intangible value that's neither measured nor communicated and represents, if you look at market capitalization or the share price of many large global companies, the share price is only very partially explained by the book value of the company. There is a considerable amount of value that is important, is essential to the functioning of companies, as these two commentators note in the quotes. And yet we haven't been very good at addressing these through our mainstream accounting. So on to the next slide. So we asked you in the poll previously, you know, what performance management looks like within your organisation. This is a definition from AICPA CIMA, and it's fairly generic because it covers the whole process of performance management. But we're focusing very much on how do we embed within decision-making, within businesses, this notion of sustainability. So not having sustainability as something separate, but actually just part and parcel of how we see, how we define and how we think about and how we act on company performance. With that very broad context and overview, I want to hand over to our first speaker, Peter Spence. Peter leads work on performance management at AICPA CIMA. He's been working with us now for some time on this project and is incredibly knowledgeable on this topic. So without further ado, I'll hand over to Peter to take you through his presentation.
Thanks, Mario. Yeah, and I really liked your slide, the PwC slide, which shows the progress that management accountants, finance departments have made between 2009 and 2019. The other thing that I found quite interesting about that particular graph is that whereas the chief execs or senior executives being surveyed here say that they generally are, they need the rate importance of these different factors at about 70 to 90%, but are being served with only about at a level of about 20 to 30%. For sustainability, the need for that sort of information is down to about 40%. And that's the most recent one last year, I find quite amazing. Next slide, please. So the way we manage businesses, the way we make decisions needs to change. And that's what this project, Integrated Performance Management, is all about. And absolutely delighted to be working with the WBCSD on this project. And I would particularly like to thank Mario Bella and Luke Blower for helping us find better ways of managing performance. Next slide, please, Matt. So this is our context slide. And it describes the way that we have traditionally thought about our ecosystems and how things are these days in the 21st century here. So in the first place, who is value for? Well, the Friedman doctrine has reigned supreme throughout the 20th century. Shareholders are still front of mind, but it's becoming much more risky to ignore other stakeholders. And risks and opportunities are now global, so relevant information is far more complex than it used to be. And in the past, managers expected to wait until they had perfect information before making decisions. But the speed and unpredictability of change now makes this completely impractical. And businesses now have to contend with volatile, uncertain, complex, and ambiguous ecosystems, whereas in the past they could count on stability and predictability. And managers the world over are grappling with the tensions between having to make decisions to deliver short-term gains without risking the sustainability of their businesses. Next slide, please, Matt. And this slide here is by Simons, 1995, Harvard. And it's looking at the way that leaders, managers, decision makers thought about performance management historically, and the realization now that actually the old ways are no longer fit for purpose. And the problem, and what this project is about, is that despite the radically altered business ecosystems that we exist in, we still manage our businesses using performance management frameworks founded on a century-old management concept. So if we could flip to the next slide, please. So as Mario explained in his slides, managers are underserved by performance management approaches in use today. Budgetary control, first codified about a century ago by James McKinsey, who was the founder of McKinsey & Company, the consultants, is still important, but companies are failing to adequately manage about 80% of the value that's not on their balance sheet. So it's not really fit for purpose anymore. But what we have done over the last 30, 40 or 50 years is make everything faster through our technologically driven ambitions to make everything more efficient. But at the end of the day, in businesses, it's still people making the decisions. And multinational businesses, people closest to the markets are best placed to be making these decisions. But using this old 100-year-old top-down hierarchical performance management framework, where goals are forced down to managers by a few people, remote from the customer, with imperfect and incomplete information, is unlikely to help businesses to succeed in our turbulent world today. Matt, could you pop up our first question in this particular presentation? Do we have results yet?
Hi, Peter. People are just voting now or getting a good number of results now. I'll just leave it open another couple of seconds and then I'll hand it back to you.
Thanks, Matt. So sort of what I would have expected here, across the board, these are key factors for most businesses. Organizational silos, limited cross-functional collaboration, first past the post there at 83%, very interesting. And that's what we've been finding through this project that we're running. Thanks, Matt. And on to the next slide, please. So this is what William Edwards Deming called the fallacy of management by the numbers. In that first box on the left there, he says, if you have a stable system, then there is no use to specify a goal. You'll get whatever the system will deliver. The goal beyond the capability of the system will not be reached. So managers have set out to control their operating models and have striven for efficiency over the last decades, over recent decades. And now they expect their rigid systems of control to deliver performance beyond what they were designed to deliver in the first place. So hardly surprising that 80% or 70 to 80% of businesses fail to reach their full strategic potential. But on the other hand, nor can they just let go of controls altogether and completely trust that managers will somehow come up with high performance, magically aligned with strategies. So in the second box here, he confirms this by saying, if you have not a stable system, then there is again no point in setting a goal. there is no way to know what the system will produce. It has no capability. But never mind what Deming says, we still persist with our rigid annual top-down cascades of goal setting and performance management. And because people fear failing to achieve these goals that they get set, they start negotiating them and they get them into their comfort zones. So is the company getting the goals and targets that they really want? Generally speaking, not, because individuals fear achieving or fear being judged for not achieving the ones that the companies do want to achieve. And so he goes on to say, as we've already remarked, management by numerical goal is an attempt to manage without knowledge of what to do, and is in fact usually management by fear. And this is the fallacy of the numbers, of management by the numbers. Next slide, please, Matt. And so how has technology helped us? This quote, attributed to Henry Ford in the days of the horse-drawn buggy, really says it all. If I'd asked people what they'd wanted, they would have said faster horses. As I mentioned earlier, technology has made everything go faster, including James McKinsey's performance management system. So now managers are left with faster horses. Next slide, please, Matt. Okay, skip through to the next one, please, Matt. Okay, so what we in this project eventually want to deliver is a practical framework for managing performance in the 21st century. And we're now in phase one of a two-phase project. Next slide. So far, we've done a review of the literature, but we found almost nothing relevant to our quest. We've been interviewing senior finance and operational leaders at great businesses to gain insights into how they're managing performance at these businesses. Our focus has been on banks, food and agri businesses, FMCG, and industrial companies. We've drafted our findings from these interviews and the literature review, and we'll soon be running round tables to explore them further. Next slide, please, Matt. And these are some of the companies that we've been privileged to engage with on our project. Next slide, please, Matt. So we believe that businesses that consider all stakeholders, not just shareholders, and how capital is material to their businesses, create value, make better decisions, and that change happens through people. So to start with, businesses need engaging, accessible purposes that their employees and customers can relate to, and then strategies and plans that their people can understand. Next slide. So the International Integrated Reporting Council has done fantastic work in raising awareness of non-financial factors, or capitals as they call them, in value generation. The main focus of their efforts so far has been to get companies to consider capitals beyond financial capital in their reporting. Next slide. And although a growing number of businesses are producing integrated reports, you recognize that managers aren't always managing their businesses in an integrated way. We've been posing a lot of questions in our interviews to try and uncover novel practices. Questions such as, what are the current sources of competitive advantage for your organization? How are the board's visions and priorities cascaded down to how people are engaged in delivering strategy? How does your business facilitate adaptability and innovation? What is the structure of the organization? What is the performance culture of the organization? And how do these affect how resources are managed and employees are engaged? What is the extent of cross-functional interaction between business units? How effective is management information in supporting integrated decision-making and performance management? How are governance and risk management processes in the organization structured and managed? And how environmental, social, and governance components are incorporated into the strategy, structure, and processes of your organization. So quite a wide variety of questions here related to integrated performance management, the way we've defined it so far. Next slide. Sorry, Matt, do you mind popping up our next question as well?
Okay, thanks, Peter. We're just giving everybody a few seconds to answer this, and then we'll display the results again.
Yes. So generally positive. More than 50% of you think that your leadership understands the factors that drive organizational performance. Thanks. Let's close that one now, Matt. Okay, so I've got 15 minutes, so not really enough time to go through everything that we are trying to cover in this, this project. So I'll try and run through resource management and organizational structure. Next slide. So Robert Kaplan from Harvard in 2013 identified that 60% of organizations don't link budgets to strategies. We're talking about S&P 500 companies here. Most businesses, they found, or we found in our study, strive for functional excellence, and budgets are aligned with functions, not strategies. That leading businesses carve out budgets for strategic projects and have strong PMO processes, but not for business as usual activities. And that where businesses have introduced some matrix responsibilities, that's for both functional and strategic responsibilities, they face challenges such as complicated resource allocation processes, and even then where there are what some managers call dual citizenship, leaders are still more aligned to their functional silos than strategic objectives. Next slide, please. So we've discussed how goals are cascaded in businesses in traditional performance management frameworks and the fallibility of this cascading process. If resources are being allocated to activities not needed for the execution of strategy, this is waste. Productivity in this case is zero. Also, time lags between the delivery of goals for activities, projects, and processes needs to be considered when to properly evaluate productivity. Next slide. So every single business that we engaged with on this project budget from a base of prior year's budget. Most allow for some inflation. One business in particular budgets on a cash flat basis from one year to the next. So in general, finance leaders find it relatively simple to make decisions on whether to give the green light to something new, even though one leader observed that optimism bias when sponsors overstate benefits and understate costs to justify their proposal is quite common. Next slide. And organizational structure, all the leaders that we spoke to talked about strategy needing interfunctional cooperation, every single one. But generally they talked about how difficult it is to get functions to work together for the good of the strategy. So the 5 challenges that we found in our study was that cooperation between functional silos was a challenge. Competition for ascendancy between functional silos. Coordination between silos, each trying to solve the same or similar projects, each on their own. Resource allocation complexity of matrixed organizations, and primary allegiance to functional silo in matrixed organizations rather than strategy. And that's all I have time for today. I'll hand back to Mario. Thank you for joining today and listening to me.
Thanks so much, Peter. You covered some very important aspects of performance management. So hopefully that provided some very powerful insights for participants. And now I'd like to introduce Professor Stefano Zambon. Stefano is a global expert on intangibles. He's written widely on the topic, and he was a founding member of WICI, which stands for the World Intellectual Capital Initiative. The WBCSD is one of the members, and Stefano has been instrumental in raising the whole issue of intangible assets on the agenda of standard setters. So now I hand over to Stefano. Thank you, Stefano.
Thanks to you, Mario, and thanks a lot to WBCSD. I'm very honored to be here. I have an impossible task because I have 15 minutes to try to give you a bit of an overview of the situation with the reporting of intangibles. Okay, let's move on quite quickly. First of all, I would like just to stress the fact that this is not only a company problem, a company issue, it's also a macro problem. This is the investments in intangibles in the United States and in Europe. The dotted lines are investments on intangibles, and the solid lines are investments in tangibles. And clearly, in both cases, the dotted lines overtook the solid lines. The yellow lines is United States, blue lines the European Union. So you can see that basically in the last 20, 25 years, in all the countries, of course, with different pace, investments in intangibles have become more important, more relevant, also in quantitative terms, vis-a-vis investments in intangible goods. Move on, please, thanks. Okay, let's go to company level. I don't think I have to clarify that there are many companies, web giants, that virtually do not have tangible assets. Despite that, the market, financial markets attribute to them a huge value. Instagram was a good example. There was 1 billion at the moment of purchase, and virtually no assets, 12 employees, and now the value is, of course, pre-COVID is 100 billion. So, and of course, there are being a number of research trying to show what has been what is the weight of intangibles vis-a-vis the capital and market value, and the various results, but always between 60 and 80, 85%. And final example at the company level is that the top 5 companies for financial value in the markets totalize $3.5 trillion value. And if you sum up the balance sheets, the assets in the balance sheet of these companies, you arrive at 172 billion. So all the gap, clearly there must be something in between. There must be something filling the gap, which are largely, not necessarily all the whole thing, but very largely are intangibles. Please. Please. Thank you. What is going on? What is going on is the fact that companies are changing production processes, the new strategic aspects. We all know that. It's research, innovation, marketing, customer relationship, know-how, managerial and organizational, entrepreneurial skills. Manufacturing, to some extent, is important, of course, but it's more ordinary business to some extent. All the phases I just mentioned, all the elements, research, innovation, marketing, customer relationship, are intangibles. And that's why, it's very often it's very often heard, the sentence, intangibles are the main drivers of sustainable value creation over time, because basically intangibles contribute a lot to maintain, to create first, of course, and after to preserve value over time. Please, next. Also, another expression that I think might be quite useful is the conceptual, that of conceptual company. Conceptual company is a company that is, of course, has a negligible physical assets, low property, plant, and equipment, low inventories. Think about digitalization, the effects of digitalization. Of course, a conceptual company is intangibles intensive, so stronger role by R&D or brands or alliances. Also, alliances are intangibles. Human resources, organizational capital, strong patent trademark protection, a certain, to some extent at least, an outsourcing of manufacturing and other low knowledge functions, and of course an extensive trade in intellectual property to protect and to grow, to make the business grow. And of course, finally, the flexible business model. I'm not saying that all the companies nowadays have this concept, these 5 or 6 characteristics. I'm just saying that many of the companies today have some of these characteristics. Approach to this, get closer to these characteristics. Even if you produce physical products, like a washing machine, your washing machine has lots of incredibly sophisticated knowledge functions that are incorporated. So lots of know-how then and lots of technology. Please, next. What I mean by intangibles, just to clarify the issue, the general definition is easy, is a source of future economic benefits that is without a physical embodiment. But however, certain intangibles are quite well known. Intellectual property, patents are of course an intangible asset with the legal rights. So, and they can be recognized in principle in the balance sheet. But to some extent, also there are also intangibles that are much maybe obvious. From, of course, the obvious ones are patents, brands, but there are skills, competences, training policies, organizational procedures, systems, processes, leadership, engagement. Some of them, as you can see, they are quite far away from an accounting definition of an asset. In this respect, I think it's quite useful to distinguish between hard intangibles that are tradable, can be licensed, can be bought, and soft intangibles, some of them that cannot be traded, cannot be bought or licensed, like leadership, or you can't buy leadership, you can't buy engagement, of course. Next, please. Why we have a problem? Because, of course, accounting, for a number of reasons, the traditional accounting that we all know is not doing a good job at this point. The IAS 38, the standard dealing with the international accounting standard dealing with intangibles, very restrictive. Basically, all the intangibles related expenses should never be treated as an investment, as an asset. Only in certain circumstances, development expenditures can be put amid the assets of a balance sheet. All the rest, all the other expenses are treated as costs rather than as an investment. Only exception are the intangibles acquired in mergers and acquisition. There's of course this attitude provokes a simple consequence that a wide range of intangibles remains, of course, unaccounted or cannot be even accountable, even worse. And so they remain outside financial reporting. You can see a list there, which is a very long list. So there's a lack of transparency, after all, about the main value drivers of a company. Drivers that investors recognize in the prices of companies in financial markets. In this respect, then, some of the important authors around the world started talking about the deterioration, the diminishing of the value relevance of financial reporting. I'll show you a graph very quickly, please. In this graph, there's a relationship between the accounting numbers, the balance sheet, the equity, and the value of the company in the financial markets. As you see, in 1950, there was nearly a perfect coincidence, a correspondence between the equity, the value of the equity in the balance sheet, and the value of the company in financial markets, which means that for accounting numbers were very important for the pricing of the company. But the more we move towards the right, this relationship becomes less and less relevant. In a sense, we are around 50%. So only 50% of the value of the company today can be related, can be traced to accounting numbers, which is, of course, a very important element of performance. We're talking about performance in this webinar. So it's clearly there's a decreasing relationship between the account information and stock prices. Next, please. Somebody can say, okay, but what's the harm there? What's the problem? Well, there are a number of problems coming out of this. This is not just an accounting problem. It is something much wider. The level of information asymmetry, in the firm, between the firm and the market, creates opportunity for insider trading, for instance. The managers are not accounted for decisions and actions in managing some of the most fundamental firm's resources. You don't have visibility. There's no transparency on research in very many situations. There's no transparency in policy for training and so on, for instance. But also there's a lack of information for investors to make a rational resource allocation and then investments, because of course they miss some of the most important information about the intangibles, which are the main value drivers for companies, especially in the medium long term. So this situation affects negatively the value measures, the market to book value ratio, affects negatively the performance measures like ROE, ROA, EVA, because of course, we comparing earnings that have been decreased by the fact that some investments in intangibles are treated as a cost and not as an investment. And so, of course, you deteriorate the cost side, so to speak. So you inflate the cost side, if you prefer, and of course, you diminish the earnings. And the prediction of future earnings cash flow can be largely flawed. And also, more seriously, internal corporate disclosure allocation can be seriously distorted, which is even more serious to some extent, because managers don't have, for instance, in very many situations, any idea of the return on the investments in research or in policy, in training, or IT, for instance. Can we pull on then the question, please, Matt? The first question, the first poll. In your company, do you report on accounting on unaccounted intangibles? Everything is working, Matt, yeah?
Hi, Stefano. Yeah, everything is working. We're just giving everybody a few seconds to answer the question, and then we're going to share the answers.
Perfect. Oh, great. Well, sounds, that's interesting answers, I think. 30% do not report on intangible value, which I think it's an interesting element. Some companies go for integrated reporting, which of course one of the obvious choices, and some other go for KPIs. So it sounds an interesting issue. Okay, moving on. Thanks, Matt. So given the situation, the problematic situation about information on intangibles, there are a number of initiatives. We don't have the time to go through the whole thing, but just for you to know that easily found in the web. ISB, the International Accounting Standards Board, as a project on the revision of the management commentary, where they will ask management discussion analysis for US type of accounting. In this new version of the management commentary, there should be many more information about intangibles. The FASB, the American FASB, as a project on identifiable intangible assets and goodwill, still about traditional. SEC, the American Stock Exchange regulator, is proposing, to enlarge the information human capital, which is a start. WBCSD as the important project on redefining value Mario told you about. Also, the French just produced 1 year and a half ago, a study about extra financial information, which includes intangibles. And the ICAS, which is the global body for chartered accountants from Scotland, but it's a global body, they have a project now about user needs, identifying the user needs about intangibles and what are the difficulties of CFO in pricing this information. EFRAG, finally, last but not least, EFRAG has launched a project about 1 year ago on better information on intangibles. EFRAG is basically an advisory body to the European Commission. It's quite close to the European Commission. And the next slide, we will see some of the results. One is the literature review on the reporting of intangibles. So see if some of you might be interested to get a flavor about what the academics say about the reporting on intangibles, which have been the findings of the scholarly research. That could be maybe a good starting point. And in March, EFRAG announced an advisory panel on their own research on intangibles. And so this is a good start. Let's hope that this will move a little bit forward the agenda. Next, please. Another important element to share with you is the fact that this WICI, the World Intellectual Capital Initiative, is the only global network dealing with the reporting on intangibles, produced 3.5 years ago, the only existing intangibles reporting framework. It's a collaboration between Europe, Japan, and United States, and it's publicly, of course, available. And it's interesting that it's a companion framework to the international reporting framework, the International Integrated Reporting Framework, sorry. So basically, this doesn't go against the integrated reporting, it goes hand in hand, but also offers other insights, other possibilities different from integrated reporting. If somebody wants to produce, some companies want to produce a report, a standalone report on its own intangibles, is of course will provide some, will find some good indications there. Next, please. In particular, I would like to share with you one figure that has been widely quoted in various congresses about the reconstruction by WICI, the WICI Global Network, about the situation in the corporate reporting sphere. You have financial reporting on your left, you have sustainability reporting on your right, but in between, the connecting, the glue, is intangibles reporting, which is now largely missing. So you have human capital not intended as human rights. That will be more sustainability, of course, aspect, but more in terms of skills, competences, engagement, identity, internal corporate image, and so on. Intellectual capital, which is our basic organizational capital, and of course, relational capital, especially to clients and the markets. So this is somehow the missing, what we think as at WICI is a missing point in the reporting sphere. Thank you. Next. The concept of business sustainability. One important, interesting concept put forward by the WICI is the fact that in order to have a sustainability of the business, you can't have only intangibles. You must have also, of course, ESG factors, but they must be articulated in such a way that the business model can somehow somehow include, all these aspects. So in a sense, a true sustainability, business sustainability over time requires, of course, ESG aspects, but also a control and knowledge and a management of intangibles, and through a business model which embodies, encompasses both aspects. In this respect, maybe there's a second question, a second poll. Matt, please. Thank you. When you talk about company value creation, how much do you think in percentage is the role of intangibles? Well, talking about value creation, that might make sense.
Okay, thanks, Stefano. People are just filling in the poll now.
Absolutely. We're really going to conclusions. It's pretty high to me. Looks quite high, which is interesting response. Thank you very much. 50% thanks. That is between 50 and 75%. Thank you for this. Okay, let's move. I wanted to show you something else. Okay, this is what we've done in the field, basically in the last year or so, in the field of intangibles. I would like just to ask you to have a look at the bullet point in red. There's a publication on the kind of a bottom, publication of a document titled "Setting of a New Agenda for CFOs, Understanding the Role of Intangibles in Value Creation." It's an open consultation. It's a document trying to show some of the unknown or perhaps not so clear characteristics of intangibles and linkages and roles to value creation. And so you're very welcome to access the WICI website to have a look at this document. It's not particularly long, but also with some questions that would be very useful to improve this document. Thanks. So let's move on. These are some of the documents produced by WICI and WICI national jurisdictions. I would like to draw your attention. One, integrated reporting for SMEs, implementation guidance. Another one on integrated reporting and integrated thinking. These are publicly available even in the IRC website. Please, next. Can we move to the next one, because probably it's easier. WICI also produced a number of KPIs available for various industries, so industry-based KPIs, not orientated towards ESG, but oriented towards value creation and intangibles. So these are, for instance, food and beverage, but there's also electricity, oil and gas, luxury, and many others, and pharmaceuticals. So they are publicly available. There's KPIs that are different from the more, as I said, ESG sustainability orientated. That might be also a part of possible solution. Next. Concluding remarks very quickly is the fact that also European Commission in a study recognized the importance of investments in intangibles to improve corporate governance, market transparency, and access to finance. ESG is not the same as intangibles, in my view. Of course, I don't have the truth, but I think conceptually there are lots of overlappings, but not the same exactly. And of course, we're probably moving towards the standardization. Possibly there are some good rumors around, and we're moving towards the standardization, hopefully, of ESG and intangibles. Next one. In fact, my point will be that instead of talking about ESG, we should talk about ESGI, because I think this is an important, would be an interesting element to consider in the picture if you want to go for value creation of companies. I don't know if we have time for the third poll, Matt, or I should just go to the takeaways.
Yeah, we have just a few minutes to wrap things up. So yeah, the poll is on the screen now. If you could help us out by answering the question on your screen, that would be fantastic. Thank you.
Thank you, Matt. How should business reporting capture more information in intangibles? The way forward, in a sense. And after we go to the final takeaways. Okay, so the majority would like to go for an enlargement of sustainability reporting. That's an interesting element. Thank you for this. And finally, this last slide, just to make a little bit of recap. If we want to talk about value creation, for me, it's difficult to forget about intangibles. Non-financial information should include also intangibles, not only ESG. That's nothing to do about the importance of. I'm not discussing the importance of ESG, but I'm just saying that there are two sides of the coin of value creation. Intangibles are key resources for organizations, and there's both internally, we need to manage them, and we need to inform our stakeholders about them externally. Business sustainability can be an interesting concept, combining the various information. Sustainability reports tend to, for me, to consider intangibles as a side, in a sense. Can intervene, like reputation, like customer relationship, but not necessarily embracing all the intangibles that are relevant for value creation. I must say also integrated reporting is an interesting step in the direction of reporting on intangibles, but to some extent, there's still shy, there's been some room for improvement. And finally, I think that if we want to talk about integrated performance like what we're doing now, we need to also take into account the role of intangibles, human, organizational, relational, which after all, as I said, are the constitutive glue of an organization. You have human beings, you have machines, you have, of course, tangible assets. In between, the connecting glue is made up of intangibles. Thank you very much.
Thanks so much, Stefano.
Thanks to you.
Hand over to Karen. Karen Delgar Sanning is from the European Commission. She's a policy officer in DG Environment. Karen, the floor is yours.
Thank you very much, and thank you for having us here, or me here, I would say. First, I can just switch to the next slides immediately. Yes, so first of all, we have some challenges we have to meet right now. So I want to take a step back from reporting, accounting, and so on, and see why are we actually looking at this from DG Environment's perspective. And we're looking at it because we're facing three crises. We have the climate crisis, we have the biodiversity crisis, and we have the resource crisis. So even though we mostly hear about the climate crisis, we actually have this natural capital. In general, we have to take into perspective. You can see that when you look to your right and see the UN SDG cake, you can see that the whole society and economy as such, of course, including businesses, depend on access to natural capital. And I didn't make a multiple choice question for this session, but I have a bet, a personal bet. So if you can think of one single business across Europe, actually the world, which do not depend on natural capital, I will personally buy your beer. So that's, you can think about that during the session. And that's why I come to the next point that, for example, 40% of the business in Europe, they depend on water, access to water. And you see companies who's going bankrupt. And I find it quite difficult to see why this is not financial aspects, why this should not be taken into consideration in an integrated management approach. So if you look into the next slide, we can see how I'm not the only one thinking that. So at the European level, we are well aware that companies have to look, that we depend on companies when we want a sustainable development in general. One of the things we have been doing is sustainable finance for taxonomy, where we're going to assessing whether issue is sustainable or not. But also in the general policy making, when you look into European Green Deal, to the European Green Deal investment plan, the recovery plan, and so on, everything is based on the fact that business and society needs to be sustainable, and the growth needs to be sustainable. We have been working, for example, for some times with the management part to see internal in the company, in the management, as the previous speakers were talking about, how can we support a better assessment of the environmental impact and so on. And that's also why we're supporting the Transparent Life project, which the World Business Council for Sustainable Development also is part of, where we try to go in and make some principal environment accounting framework. At the same time, we're also looking in the more corporate law part of the equation. And what I want to go more into is the equation with the reporting and in accounting in general. So if you use the next slide. Yes, here you can see how we have been looking at it for some time. Again, I've been also seeing this little presentation, as you can see. But here you can see that you have the internal management and you have the external disclosure. And here you have the GRS that's been so on for some times, and internally you also have reporting or accounting frameworks. And we've also, in DG Environment, we've been working before, even looking into this project. We also looked into the OEF, where we in 2014 came out with the organization environmental footprint methodology, where a company can go in and say, if we are sustainable, we can use this methodology, which is reliable and accountable. So we have many different standards and approaches, and right now the lines are getting a little blurry, you can say, which from my point of view is a very good thing because it's more integrated. But if you go to the next slide, you can see a little about what we have currently in EU legislation. This is the Non-Financial Reporting Directive, which states that large listed companies above 500 employees need to make non-financial reporting. It should be, I would say, a part of the management report, but most companies choose to have it in a separate report, a little glossy environmental or CSR report. It is, as you can see, it is not required to use a specific standards. We have developed some recommendations and guidelines, but that is just for companies to choose. And this also means that there's not sufficient consistency between the reporting. And when you go into the next slides, you can see some of the things we're looking at currently when we're revising the non-financial reporting directive. I'm not saying that everything should be in legislation. I'm not saying this is what we're going to do. I'm saying this is the option which have been presented in the open stakeholder consultation, which ended a few days ago, where you go in and see which companies should be required to report this information. Should it be only listed big companies? Should it be all big companies, and so on? Should there be an assurance system? Should it be in the management report and not in a separate report, and so on? And as it was mentioned earlier, Vice President Dombrovskis have been out saying that EFRAG should do some preparatory work in order to see if there should be developed standards and how it should look like. It's a very preparatory state of play we are at right now, but it's just to say these are some thoughts that we are assessing currently. And as you can see, also intangible assets and digitalization is a big component in our discussions. I believe that most people would more want to ask questions about these issues, so maybe I should end it for now, and then we can have a more interactive process from now.
Thanks, Karen. Very valuable insights about work you're doing at the European Commission. as Matt has been prompting participants throughout the session so far, if anyone has any questions, can you please ask them through the chat function? I think we have one question so far from Mark from the Capitals Coalition. Stefano, did you want to respond to Mark's question?
Yeah, no problem. Thank you, Mark, for your questions. Clearly, restriction on time available didn't allow me to, to expand the number of concepts. What I meant to be is, of course, the fact that intangibles cannot stand on their own. But however, they need other capitals or other factors to work together. My attention is that to drive, the attention to the fact that intangibles are a bit forgotten. And I'm very happy that Karen just said what she said about intangible assets, because if we can't talk about value creation, I think value creation is a concept that somehow we tend to recognize, but without the various capitals interlocking between between themselves. I think that is a very important element. I'm sorry if I didn't have the time to develop this further.
Thanks, Stefano. Any other questions from the floor? Anything to Peter, Stefano, or Karen on their presentations? Well, given we've got a little bit of time, maybe I'll ask a few questions just to get things going. So I think this is to you, Stefano. Does it matter whether there is a gap between book and market value? Because your presentation demonstrated there is a substantial gap often. And so could you just explain to the participants why that matters, why understanding that gap matters?
Yeah, I mean, clearly many people get quite surprised when they are confronted a little bit, when they face such a huge difference. In case of the web giants, this is ridiculous. Many people told me, well, why we should prepare accounts if there's no relationship with the corporate value? Okay, so as an old accountant, I think accounting has a role that is not only to represent to fully represent value of the company. Clearly, accounts represent a certain type of value according to certain rules that have developed over the centuries. And I think in this respect, accounting will still have a very important role to play. Of course, when we talk about capital markets, they have nowadays we have so many sources of information coming from social, coming from you name it, that of course the value of a company can be modified largely in very few minutes. COVID-19 is unfortunately a bad example, or is a good example depending how you want to take that. Because of course, nowadays the financial statements cannot reflect now, what is happening with COVID-19. It will take it, much longer, probably other 3 or 4 months to see the first serious impact of COVID-19. Whilst we know that markets move to the light speed. In this respect, I don't think accounting should perfectly reflect the value of the company. However, should provide information that are the basic ingredients for stakeholders, and in particular investors, but not only, for somehow calculating by themselves the value. without omitting certain key information. So I think that is not necessarily the problem, the gap. The problem is the information that is missing, that somehow the gap suggests.
Thanks, Stefano. Karen, a question to you. What is the role of standards and regulation in managing and communicating business value creation? With a view on, you made some points about, water and the example you gave there about how a lot of this, what has been labelled as non-financial actually potentially has quite significant financial implications, and a lot of financial activities are regulated. Any thoughts on the role of standards and regulation in the green agenda forward?
You talked a little loud, but I will try to answer what I heard. First of all, we are looking into standards, as you can hear. We are both looking at it from accounting perspective, internal accounting, and I would say more normal accounting. So both with the project where you're also involved, that's more management accounting approach. But we're also trying to link it over to, I would say, the reporting under the NFRD, where you already, as you can see, there are already quite substantial requirements there for reporting on ESG factors. It's a business, it's a strategy, it's outcome, due diligence, it's impact both on company and society. So it's already there for the biggest companies. So of course it's only there and required by law because it's important. It's important to see which value the company has and also to assess the risk inside of it. So in that perspective, we look at the standards because we can see there's so many different standards across the world, even inside the European Union. We have many different standards. And companies tend to feel they're overburdened with standards and don't know exactly which one to choose and how to approach it. So some way of standardization is, of course, on the top agenda. This question is just, should it be directly linked to legislation? Should it be a voluntary standard again? Or how should we do this the best way in order to make the best system for the companies? Because we don't want to overburden with administrative burdens, but at the same time, we also want to have a system where we get reliable data and they might even get a good outcome themselves. Oh, can't hear you. You're on mute, Mario.
Apologies. In terms of regulators, we have very clear regulation of financial reporting. Moving forward, do you see this non-financial information coming within the scope of those security market regulators, or is that really still an open question?
Yes, I think it's a little too early to answer that, especially because the public consultation just ended a few days ago. So right now, my dear colleagues are assessing this income, and we have to assess this internal commissions, see if it was as we predicted or not. I won't rule it out. I won't say it will be. We don't have a decision yet to how what the outcome should be, but we are aiming to have something to adopt in early 21. And within that time frame, many things can happen.
Indeed, understood. Thanks very much, Karen. So now just moving on to, actually, do we have another question? Yes, we do. It's for you, Stefano. How would you measure the value of an intangible by the input required to create it, or by the impact it caused, or even by the impact it will create in the future? Good question.
Simple question. And so I think that clearly the we tend to value, I think, an intangible for the positive consequences it has. Otherwise, we would value an intangible by cost. Incidentally, when we talk about reporting on intangibles, as I tried to point out, we should not forget that many of this information are non-financial in nature. So we can't think that there have been some attempts around the world to transform everything, even organizational climate, which is a very important intangibles, organizational capital, into pounds, euros, dollars, and so on. I think many of these cases, the best way to measure is these intangibles is not euros, is not the monetary way. So in a sense, certainly, so coming back to the question, certainly is the impact, the consequences for the organization and for the behavior of the organization. But we should think that we deal with most of the cases with KPIs, and KPIs become much more meaningful. I'm sure Peter can be you know, much more in depth, go much more in depth than me. And KPIs make sense when you have a series, a temporal series, a time series of KPIs, because of course then you can see the trend. I think we should get, we generally collectively, the markets, the analysts, should get more and more used to non-financial information. And so non-financial information for me means information that is not expressed according to monetary units. So I am 184 centimeters tall, okay? This is a non-financial measure. So it's clearly more difficult. We don't have a minimum common denominator when we talk about non-financial information, also about intangibles. This, of course, has an impact on comparability, for instance, of course, because we can't compare one-to-one, like one apple with another apple. It's not that easy. It's not for many intangibles. But certainly the consequences, and especially the time, the trend over time.
You're on mute, Mario.
Apologies. Sorry about that. We've had another question about what is value, because we have all been referencing value and value creation, but do we have a common understanding of value? And that's a fundamental aspect of this project, because in accounting, value usually comes down to the sum of future cash flows discounted by some discount rate. And so we can include the impact of externalities either by adjusting the cash flows or adjusting the discount rates. But there's still an open question about what value are we talking about? And I think this creates a lot of confusion in business. And it leads to another question we've received. And I'll put this to the whole panel, but maybe Stefano, if you come in initially. You can't necessarily monetize everything. How can it be brought into the books to represent market value and equalize market to book ratio?
You disappear, your voice disappeared, Mario, for a few seconds. But if I well understood, is about, and I can see in the chat, the value of intangibles. You know, there's a proposal to put it in the books, so somehow to equalize market value and accounting value. I think to some extent this will be too much, in the sense that accounting plays different roles, not only that for capital markets, of course, which is of course important. You have to think about SMEs, you have to think about unlisted companies, you have to think of, you know, internal management processes, and of course Peter will tell us something about. So I think personally that the problem is to report on intangible doesn't not meaning necessarily measure financially all intangibles. That will be a completely different thing. Of course, it's a complex topic. And of course, it would be nice if the European Commission, as Karen pointed out, that potentially might happen, there might be a discussion maybe further down the road about how to deal with intangibles, because we talk about digitalization, and we're not sure that we're dealing also with the reporting implications of digitalization, if not costs. But we're talking about much more than costs. So I think market value has a certain meaning that is much forward oriented. Accounting has a certain role, can be improved. I'm in favor of improving accounting. IS 38, according to the words of the chairman of ISB, is a rudimentary standard. He said that in 2012. So, I mean, I'm just quoting here. And, but I think, you know, there's room for improving accounting, but doesn't mean necessarily we want to have exactly the same number. I think we need to provide information to investors and to stakeholders in this respect. As to the value question, it's of course an old question and it's fascinating. Clearly, it depends also very much on the temporal horizon you just adopt. Because if you adopt short term, probably means cash flows. But the longer you look, probably the wider concept of value that you have to adopt. I think that might be an oversimplification, so I apologize for being too simple perhaps, or simplistic, but somehow it's also time linked to some extent, and of course to which are the references, the stakeholders you consider as the most important. But it's an open question to a large extent.
Thanks, Stefano. Any of the other presenters want to make any remarks in respect of those questions?
So I would say that I agree with absolutely everything Stefano has said. I think one of the questions as to how to bring it into the books, and what Stefano said was that you can't completely place a financial value on everything that is intangible. But what we also said at AICPA-CIMA is that strategy and its execution and the generation of value is a conversation that ought to be had between decision makers across businesses. And you could take the view that the market and the pricing of the company's shares have nothing to do with management, and therefore you don't have a conversation about it. But I would take the view that the more you can talk about value from the investor's perspective, the more you'll be able to identify where value is being driven, or how value is being driven in an organization. And I don't think it generally pays to ignore it and treat it as an external debate to be had within the market. In terms of reporting, which I think is probably more the question, obviously we're governed by standards, and therefore there's certain things you can't say in your financial statements and in your strategic reports, etc. But certainly, I think integrated reporting provides opportunities to narrate value creation through a comprehensive description of your business model, to help external investors, external users of reports to better understand how value is created within an organization.
Thanks, Peter. We need to, in the interest of time, we need to now round out the session. So just some concluding remarks from my side. Matt, if we could advance to the next slide, thank you. So we've been thinking within the WBCSD, how do we frame this project? How do we think it through? We've been in this diagnosis phase with the great work from AICPA, CIMA, helping us to understand the current state of play, moving towards this call to action. And we think that where we'll end up is a series of options for companies to consider, and then you know, different pathways, and then for us obviously to support that transition. And so we think our current thinking, and again this is about engaging in a dialogue with our membership, understanding the enabling environment and conditions. Why do some companies take a wider view of performance? Why is it some are still very much in that shareholder primacy view that Peter was talking about? Then what are the specific processes and approaches to deal with this? And then what are the decisions that flow? So what are the specific decisions that you make within a business, and how can you apply this thinking to those decisions? So getting very much into use cases and looking at different methodologies that have been employed by companies around the world to do this. And so if I could just advance to the work streams and engagement opportunities. Thank you, Matt. So we are working with the European Commission on EGAP, which is essentially a literature review looking at the methodologies in terms of understanding impacts. We would welcome you to review the Intangibles guide, the exposure draft of that guide that's been put out by WICI. We plan to have a virtual roundtable, so we encourage you to participate in those, and also if you're interested in being interviewed for this project, we can easily set that up. So in terms of engagement, we have a working group that has been meeting. It's quite a dynamic group, and again, we'd welcome members to join that group if this is a topic of interest. We're also doing some work with Oxford and the SAID Business School there at Oxford. We're looking at a workshop in the Q4 of this year, and also in Q4 looking at impact valuation roundtable as well. So lots of opportunities for members to engage with this. You know, let us know if you want to be on the mailing list, if you want to just understand sort of what developments are taking place, but clearly we'd love you to play a more active role. And with that, I want to just conclude the session. Just the next slide to promote a workshop we have coming up with INSEAD on governance, a related topic, looking at governance through this COVID-19 crisis. You can click on the link and we'll share these slides with you after the session today. If you're interested, you're very welcome. And then onto the very last slide. We have loads of resources on our website. Please look out for those. Watch out for the slides and the recording of this session, which we'll send to your inbox. And please stay engaged. This is an important project, and we want to make sure that we engage our members very actively in taking this work forward. So thanks very much, everyone. I hope you found the session interesting, and please provide any feedback you have. Thanks again, and have a good day.